Hello, everybody. Welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thanks for joining us. It's been a little longer between E-News recordings, so we apologize for that. We had some vacations. And there's obviously a lot going on in the economy and in the capital markets. And so we are happy to talk about those today. So I'm going to talk a little bit about the central bank, our central bank, the Federal Reserve. We have a new Federal Reserve Chairman, Kevin Warsh, and they made an interest rate decision this week. And then Josh can talk about what's going on in markets, because that's really interesting. And then finally, he can talk some more about our asset allocation and where we have your money invested and how we're the most optimistic we've been about our asset allocation in probably more than a decade. So like I said, this week, the Federal Reserve had their policy interest rate setting meeting. They left the Fed funds rate unchanged at between 3.5% and 3.75%. But what was very interesting about the statement from the Federal Reserve and then the press conference from Kevin Warsh is I've never seen anybody talk for 30 or 40 minutes and not really say anything. So good on him to be able to do that. But the interesting thing was they made it very clear, and he's been very clear since he became chairman of the Fed, that the Fed is going to make sure that they do everything they can in their power to make sure inflation gets back to the 2% target, which is the mandate for the central bank. Yet they're not doing anything about that. They're just talking about it. And so the market had a big sell-off on Wednesday, as a result of that, sort of saying, wait a second, you say you're going to do everything, but you're going to lose credibility unless you start to hike rates. And so we saw a big move higher in the bond market in terms of rates. So bond prices went lower and rates went higher, especially at the long end of the yield curve. So 10, 20, and 30-year treasuries, their interest rates spiked. And so maybe the central bank is saying, well, we'll just let the bond market do the heavy lifting for us. We'll just keep talking about it. But if they just talk about it and they actually don't do anything, at some point, the market will certainly revolt. The bond vigilantes will revolt. So we're seeing increased volatility. And remember, as interest rates go higher, it makes capital allocation decisions by businesses more important. They have to be economical decisions because higher rates matter a lot to long duration assets like technology stocks. And that's what we're seeing, a rollover in the last 2 months, in stocks that make up the NASDAQ and some of these high flyers. And Josh can talk about a big happening that happened on Thursday morning.
Yeah, I'll first touch on the big news this week, which, you have sort of these monumental blow-ups occasionally. It's been a few years since Archegos and Bill Hwang. He ended up going to jail for 18 years as a result of some of the action that was happening a few years ago when some of those big technology stocks reversed and dissolved that fund. You go back a couple of decades. When I was just a young man, long-term capital management imploded during the Asian currency crisis, and resulted in many epochal books written in the history of finance. But this week, it's Leopold Aschenbrunner, a 24-year-old German whiz kid. There was a researcher that stole some confidential information at OpenAI, went and subsequently started a hedge fund, was up 2,200%. As is the case in all of these instances, leverage is not your friend. And the 2,200% wasn't enough, so they levered up those the positions reversed over the last few weeks, and the fund, which had grown to a size of 45 billion in net asset value for a 24-year-old, in just 2 years, just astonishing numbers, was essentially liquidated on Thursday. Ken Griffin, the leader of Citadel, sort of the Grim Reaper of finance, ended up buying the disaster pieces that were left in the disaster. But that maybe is a reason for some of the volatility also that we've seen this week. But the big news, of course, is, the AI trade's been reversing for the better part of a month and a half now after a dead July. And that's sort of a good segue into why we're so excited as money managers and asset allocators, is we haven't really seen sort of a helter-skelter market like this in a decade. And on days when these AI related positions are getting slaughtered, what you're also seeing is small caps and low volatility stocks ripping higher, some 2% higher on some days, where the broader market will be significantly negative. And that helter-skelter trade has been going on for a couple months now, but it's really where it really sort of highlights this dynamic that very eerily echoes the early 2000s and the reversal of the tech telecom media bubble. And that's why we're so excited is diversification is working fantastically this year, just like it worked fantastically last year. It's just different asset classes that are leading the way higher in the first half of 2026 compared to last year. And, we hope this continues. Again, we don't want to jinx ourselves here, but we haven't been this excited for a decade.
Yeah, I mean, there's big parts of the market that are selling off and in big time correction territory. A lot of big technology stocks are down 20, 30, 40% from their all-time highs. And then when we look at our portfolio, it's doing really well. We're taking advantage of the higher yields, especially on the short end in corporate bonds and some of these other bond markets. So we're really excited about what's happening actually in the markets because some steam is coming out of the markets, but it's not affecting our portfolio in a meaningful way. In fact, we're the beneficiaries of a lot of the steam coming out of this high flyers and going into these other parts of the market, which we're really encouraged by. And if you're a client of ours, you should be encouraged too. So this is sort of best case scenario. Markets are interest rates are creeping higher, which is letting some of the air out of the balloon on the high flyer names, and it's moving. That money's moving into these small caps, value stocks, all these international, these positions that we've had for a long time. So like we said, this is best case scenario for us and our clients. If you're in that high flying tech stock universe, not so good for you. So as always, if you have questions about your account or your situation, please do call us at the office or email us and get on our calendar. The number here is 800-743-0988 or Josh or Tyler at northwestquadrantwealth.com. We hope everyone has a great weekend, and we'll see you in a couple weeks.